Fundamental analysis is a comprehensive approach to evaluating company value through financial statements. It's one of the most powerful tools investors use to make informed decisions about which stocks to buy or sell. Throughout this video, you'll learn how to assess whether a company is financially healthy, how to read its financial statements, and how to determine if a stock is worth investing in based on the underlying business performance. Fundamental analysis is a method used to evaluate a company's intrinsic value by examining its financial statements, business model, competitive advantages, and economic factors. The primary goal is to determine if a stock is overvalued, undervalued, or fairly priced compared to its current market price. The key principle behind this approach is that stock prices eventually reflect the true value of the underlying business. Even if the market temporarily misprices a stock, its price will eventually align with the company's actual worth. To conduct fundamental analysis, you need to understand three core financial statements. The income statement shows revenue, expenses, and profitability over a specific period, giving you insight into how much money the company makes. The balance sheet provides a snapshot of assets, liabilities, and equity at a particular point in time, showing what the company owns and owes. The cash flow statement tracks actual cash movement in and out of the business, which is crucial because profit on paper doesn't always mean cash in hand. All three statements interconnect to provide a complete financial picture of the company. Profitability ratios help you understand how efficiently a company generates profit. Return on equity, or ROE, is calculated as net income divided by shareholder equity, and measures how efficiently the company generates profit from the money shareholders have invested. Return on assets, or ROA, is net income divided by total assets, showing how efficiently the company uses its assets to generate earnings. Net profit margin is net income divided by revenue multiplied by 100, representing the percentage of revenue converted to profit after all expenses. Operating margin is operating income divided by revenue multiplied by 100, indicating profitability from core business operations before interest and taxes. Valuation ratios help determine if a stock is priced appropriately. The price-to-earnings ratio, or PE ratio, is stock price divided by earnings per share, showing how much investors are willing to pay for each dollar of earnings. The price-to-book ratio, or PB ratio, is stock price divided by book value per share, comparing market value to accounting book value. Earnings per share, or EPS, is net income divided by outstanding shares, representing the company's profit allocated to each share. Dividend yield is annual dividend divided by stock price multiplied by 100, showing the income return on investment through dividends. Liquidity and solvency ratios reveal a company's financial stability. The current ratio is current assets divided by current liabilities, measuring the ability to pay short-term obligations with liquid assets. A ratio above 1 indicates the company can cover its short-term debts. The quick ratio is current assets minus inventory divided by current liabilities, providing a stricter liquidity test by excluding inventory, which may not be easily converted to cash. The debt-to-equity ratio is total debt divided by shareholder equity, showing the company's financial leverage and risk level. The interest coverage ratio is EBIT divided by interest expense, indicating the ability to meet interest payments on debt. Efficiency ratios measure how well a company manages its assets and operations. Asset turnover ratio is revenue divided by total assets, showing how efficiently the company uses its assets to generate sales. Inventory turnover is cost of goods sold divided by average inventory, measuring how quickly the company sells and replaces inventory. Higher turnover generally indicates efficient inventory management. Receivables turnover is revenue divided by average accounts receivable, showing efficiency in collecting payments from customers. Days sales outstanding is 365 divided by receivables turnover, representing the average number of days it takes to collect payment after a sale. Beyond numbers, qualitative factors are equally important in fundamental analysis. Competitive advantage, often called an economic moat, includes brand strength, patents, network effects, and cost advantages that protect the company's market position from competitors. Management quality involves assessing the track record, integrity, capital allocation decisions, and whether management's interests align with shareholders. Industry position examines market share, competitive landscape, barriers to entry, and industry growth trends. The business model evaluation looks at revenue predictability, scalability, customer retention rates, and how sensitive the business is to economic cycles. Here's a systematic approach to conducting fundamental analysis. First, review financial statements by analyzing the income statement, balance sheet, and cash flow statement for trends over multiple years. Second, calculate key ratios including profitability, valuation, liquidity, and efficiency metrics to quantify the company's performance. Third, compare with peers by benchmarking these ratios against competitors and industry averages to understand relative performance. Fourth, assess qualitative factors by evaluating management quality, competitive position, and overall business quality. This comprehensive process helps you make informed investment decisions. Let's recap the essential points. Fundamental analysis combines quantitative metrics with qualitative assessment, giving you a complete picture of a company's value. Financial ratios provide valuable insights into profitability, valuation, and financial health, but they must be interpreted correctly. Always compare metrics across time periods and against industry peers for proper context, as a ratio in isolation can be misleading. Finally, remember that long-term investing success requires understanding business quality and competitive advantages, not just looking at numbers. Master these concepts, and you'll be well equipped to evaluate investment opportunities effectively.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.